Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing SoFi's stock so we can determine if it's a buy or a sell. SoFi is an online bank and personal finance company. It offers student, auto, and personal loans, as well as mortgages, credit cards, investing options, and online banking. They have a crazy policy where they charge no fees for loans. Of course, if you take a loan, you do need to pay the interest on it. They applied for a national bank charter in July 2020, but they didn't actually receive their charter until they acquired Golden Pacific Bancorp last year. SoFi was funded by a SPAC, a special purpose acquisition company is formed to raise money through an IPO, then acquire a private business to help them go public. This is also known as a reverse merger or reverse takeover. In June of 2021, the merger was completed and SoFi received $2.4 billion in cash proceeds. The SPAC that acquired SoFi was Social Capital. The company is headquartered in San Francisco, California, and was founded in 2011. Let's get started with the model. This is a mid-cap company, 6.5 billion market cap. They're trading at $7 a share, and they have 941 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They have such big negatives in free cash flow, it gets worse each year. In the trailing 12 months, it's negative 8.5 billion. Net income is the profit or loss on the income statement. It's revenue minus expenses. That's also negative each year. Revenue is their interest income, and that does grow nicely from $500 million to $1 billion to $1.6 billion. Now it's $1.7 billion in the trailing 12 months. This is the company's first quarter income statement. This shows us first quarter of 2023 compared to first quarter of 2022. The way banks make most of their money is they take your deposit funds. So let's say you deposited $10,000 in SoFi's bank. They may pay you 1% interest, but they take that $10,000 and lend it to someone else and charge them 10% interest. So in this example, they make a 9% spread. The interest they received on loaning money out to people was $357 million. They also receive a small amount in securitizations, $11 million in other. So total interest income, $372 million. But like I said, they have to pay interest on their deposits. They paid $73 million of interest to the people depositing money at their bank. And they paid $54 million in securitization and warehouse fees. So the interest expense is $136 million. Net interest income, $236 million. Let me show you a more detailed breakdown of this $236 million. Here's the $236 million. They received $370 million of interest income. They actually deposited money with other banks. They deposited $1.8 billion and received $8.4 million of interest. The interest they received on those deposits is 1.87%. They invested $437 million. The interest they received on those investments was $5.7 million, a rate of 5.2%. They invest in pretty safe stuff. Here are some of them: U.S. Treasury securities, corporate bonds. Agency is Fannie Mae, Freddie Mac, or Ginnie Mae. But a bulk of their income is from loans. They loan money to a lot of people, and those people buy cars, houses, pay for school. Sometimes people take personal loans, maybe to pay off their credit card debt, go on vacation, fix up their house. As of the first quarter, they lent out $15 billion, and they received $357 million of interest from those loans. The blended rate is 8.6%. 8.6% of $17.2 billion. Total interest they earn is $371 million. They also have non-interest earning assets of $3 billion. So total assets, $20 billion. A non-interest earning asset is cash. This is their balance sheet as of the first quarter. You see they have assets of $22.5 billion. This $20.3 billion is a subset of these assets. You can see they have cash of $2.5 billion. That's non-interest earning. Restricted cash of $500 million. So if you sum these two up, it's pretty close to 3072. The balance sheet has goodwill, PP&E, and that's not on this sheet we're looking at. This picture is from their 10Q. It gives us a breakdown of their interest income. That's why it's a subset of what's on the balance sheet. Now let's look at the liabilities that are connected to the interest earning assets. If you deposit $10,000 at SoFi's bank, that's an asset for you. On your personal balance sheet, you would list that $10,000 as an asset. But according to SoFi, it's a liability. They list it as a liability. It's something they owe you. They collected $1.9 billion from people who deposited money into their checking account, and they paid 2.7% interest on that. So they paid out $13 million of interest. If you sum up all their savings accounts, it's $5.5 billion. They pay 3.5% interest. It's a pretty nice interest rate. Time deposits, $1.2 billion. They pay 4%. A time deposit is money that cannot be withdrawn until a certain time frame. If you buy a 1-year CD with SoFi, that's part of the time deposits. And you don't get that money until 1 year. So the total interest-bearing deposits with SoFi is $8.6 billion. They paid $73 million of interest. That's a rate of 3.4%. Warehouse facilities, $2.9 billion. They paid 5.5% interest on that. A warehouse facility is a way for a bank to provide loans without using its own capital. So it's like SoFi took out a line of credit with another bank for a total of $2.9 billion. So they had to pay $40 million in interest payments just to have access to this warehouse facility, to have access to these funds. If you've ever taken a HELOC, it's the same thing, a home equity line of credit. Securitization debt, $874 million. They paid $10.4 million, 4.77%. Securitization is a way for banks to get loans off their balance sheet. SoFi would use some of its loans as collateral for a bond. They would work with an investment bank to issue the bond. Let's say they gave the investment bank $1 billion of loans. The investment bank would issue a bond. Let's just say it's a $1 billion bond. And once the investment bank finds investors for the bond, they give most of that money back to SoFi. Now those loans are off SoFi's balance sheet, and it has the money to loan more money to other people. They have $14 billion of interest-bearing liabilities, $8.6 billion up here and $5.4 billion here. And they paid $135 million of interest on all this debt at a blended rate of 3.9%. The way they fund this $17 billion of loans is from here, from the deposits, their warehouse facility, etc. So they receive $371 million of interest. They pay $135 million of interest. So their net interest income is $236 million. So their margin, their net interest margin is 5.48%. That's their return, their profit from using these funds. Let's go back to their income statement. Last quarter, their net interest income was $94 million. It went up about 150%. Now it's $236 million. For non-interest income, they received $126 million on loan origination and sales. They had negative $3.2 million of income from securitizations. They received $12.7 million from servicing the loans. They made a pretty good chunk in their technology and solutions, $73 million, and other $27 million. Just to clarify, the $3.2 million is not an expense. It's a mark-to-market valuation, but this will be reversed out on the statement of cash flows. So total net revenue, $470 million, up from $330 million in the same period last year. Now let's look at their non-interest expenses. They paid $117 million for their technology and products, $175 million in sales and marketing, cost of operations $84 million, general and admin $124 million, and they have to post a provision for credit losses, $8.4 million. So their total non-interest expense is higher than their net revenue, so they posted a loss before taxes. They received a $1.6 million tax credit, so their net loss is $34 million. It looks like they have a mark-to-market gain on their available for sale securities, so they have an unrealized gain of $2.2 million. Their loss per share is better this quarter, a loss of 5 cents. Last year was a loss of 14 cents. And they are adding a lot of shares. They had 852 million last year. Now they're up to 929 million. When a company's not profitable, they tend to dilute shareholders because they need money from somewhere to pay expenses. It's either dilute shareholders or take on debt. Let's go through their first quarter 2023 presentation slides. They had net revenue of $472 million, up 43%. Record EBITDA of $76 million, up 770%. They added 433,000 customers. That's up 46% compared to the last quarter. They added 660,000 products. So some customers use more than one product. Some people may open a savings account at SoFi and take a car loan. And that's also up 46% quarter over quarter. SoFi is a one-stop shop for digital financial services that helps members borrow, save, spend, invest, and protect their money. We delivered another quarter of record financial results and generated our 8th consecutive quarter of record adjusted net revenue, which was up 43% year over year. They also had their 3rd consecutive quarter of record adjusted EBITDA at $76 million. Net revenue $472 million, up 43% compared to the first quarter of 2022. Their net loss is $34 million compared to a loss of $110 million last year. EPS of -5 cents compared to -14 cents. Their slides give us a lot of detail. It shows us all the quarters in 2020, 2021, and 2022. And of course, the quarter we're looking at, the first quarter of 2023. So in the first quarter of 2020, they had 1 million customers. It more than doubled 12 months later to 2.3 million. It went up 70% from Q1 2021 to Q1 2022. It's up to 3.9 million. It jumped up 46% from Q1 2022 to the current quarter. I didn't even realize it's down here, 46%. I was doing the math on my phone. So this is not a good trend. They were growing a lot more in the past. They grew 110% in Q1 2021. That's compared to Q1 2020. Then 113%. As you can see, it just keeps going down. You generally want to see it go up. I know it's harder to grow as you get bigger, but investors like to see growth in every category. They never like to see any number detracting. They added the most customers in Q4 2021, 523,000. They provided 8.6 million total products. It went from 1.2 million. It grew 113% the following year. Then it grew 105% the year after that to 5.2 million. Then it grew 53% a year after that to 7.9 million. Now it's up to 8.6 million. Once again, the trend is going down. The growth is only 46% year over year. It was over 100% for 5 straight quarters. And in Q4 2021, they added the most products, 905,000. Let's look at their Galileo accounts. In April 2020, SoFi acquired Galileo. They paid $1.2 billion for the company. It's a similar trend as the other slides. They grew over 100% for a few quarters. Now it's dropping. It's down to 15% in the current quarter. They actually lost customers. They have less customers in the first quarter of 2023 compared to the prior quarter. They are up 15% year over year. That's comparing Q1 2022. But this is not good. You don't want to see this. SoFi pretty much concentrated only in the US. One of the reasons they acquired Galileo was to have exposure to other countries. It gives them exposure to Canada, Mexico, and Colombia. I can't find in their 10Q where they talk about the decline in accounts with Galileo. But I know Galileo accounts are much smaller than the accounts with their main products. Maybe they're focusing more on the larger customers, which generally aren't Galileo customers. Here's their net revenue and EBITDA the past 5 quarters. They had some nice jumps from Q1 to Q2 2022, and a really nice jump from Q2 to Q3. But since Q3, it's been small increases. Especially this most recent quarter, it only increased 17 million. Adjusted EBITDA grew a lot from 9 million to 20 million. It more than doubled. Then from 20 to 40, it more than doubled again. 44 to 70 is a nice jump. Not quite double, but a pretty good jump. 70 to 76 is pretty small. They did beat their target. The target was 430 to 440 million. And they got 460 million of net revenue. So they beat it by 20 million. They crushed EBITDA. Target was 40 to 45 million. They got 76 million. So they beat it by 31 million. Their next quarter target, second quarter 2023, is between 470 and 480 million. EBITDA 50 to 60 million. So if they do hit these targets, the stock price should go up a lot. Their guidance for all of 2023 is $2 billion of revenue, and they project positive net income in the fourth quarter. That will be the first time they had positive net income if they do get that. In the first quarter, they originated 525 million of student loans. It was over 1 billion in the first quarter of 2021, so that dropped a lot. Personal loans, 3 billion. That's the highest ever. Home loans, 90 million. That dropped a lot. It was almost 800 million in the second quarter of 2021. 1.4 million lending products. That's the highest ever. Revenue, 325 million. That's a new record for them. Their gross profit, 209 million. That's also their highest ever. Their net revenue in a technology platform was only 78 million. It was over 80 million in the 3 prior quarters. And their revenue in financial services was 81 million. That's their highest ever. That's gone up a lot the past several quarters. It was only 6 million in Q1 2021. So their total loss is 24 million, which looks like their best ever. It was really close to Q2 2021, but a lot better than the past few quarters. Their adjusted EBITDA was 76 million this quarter, a little better than last quarter, but it's much better than the first quarter of 2022 of 9 million. Let's look at the capital structure. 5.5 billion of equity, 6.3 billion of debt. They have 47% equity, 53% debt. Their net debt is 3.3 billion, so that means they have about 3 billion of cash on that balance sheet. I give them a WACC of 8.8%, and that's the discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 23 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $10.7 billion. We divide that by 941 million shares. And we get a calculated stock price of $11.38. They're trading at $7, so they're trading at a 39% discount. It's a buy according to the model. I assume they would have positive free cash flow by 2026, because right now it's only negative. So at some point, I have to assume they would have positive free cash flow. Then it would be impossible for me to value a stock if I only assume they would have negative free cash flow. Another 14 analysts priced this stock, and the average price target is $7.43. They say it's 23% undervalued. This is where they've been trading historically. It looks like the stock peaked at about $26 a few months after they started trading. Then it got pretty low at one point at the end of 2022. It was around $3. It has come up since then, but it's down a good amount since they started trading. If you see a green line, that means there's more buy orders than sell orders, and the stock price goes up. If you see red lines, there's more sell orders than buy orders, and the stock price goes down. And the higher the green bar, there's that many more buy orders than sell orders. When you can't really see the bar at all, that means buy and sell orders are pretty similar. There are 56 companies in the same industry as SoFi, and SoFi's debt to equity ratio is similar to the median. They do not pay a dividend. Most companies in this industry do pay a dividend. They have the worst free cash flow. They rank 13th in market cap at 6.5 billion. They should probably be 10th. Price to book is probably the most important stat when looking at a company like this. Their price to book is 1.2. So investors are paying $1.20 for $1 book value. Price to book is market cap over book value. Their price to sales is 3.8, which is worse than the median average. They generate 1.7 billion of revenue. We don't have 5 years of data, so we can't look at their annual revenue growth rate. They've been around a lot longer than 5 years, but they haven't been public for 5 years. So to summarize, I have them trading at a 39% discount. They've been around 12 years. I know they're a really popular company, especially with younger people. It looks like they're not growing nearly as much as they used to be. Banks are really hard to value, and it's confusing looking at their financials. I hope I explained it well enough where you understood most things. I ranked their free cash flows 1 out of 10, their revenue 8 out of 10, and their ratios 3 out of 10. So let me know what you think. Give the video a like, subscribe, or comment below. If you want to be a member, you can click on the link in the description below. Thanks for watching.